too. So that's one thing in terms of just, where that has trended, because I was surprised yesterday when there were a few familiar faces up there even that had been entrepreneurs before. So, I don't think that that's sustainable over time it depends how mature the company is, right? The concept that they've just been working on it for 6 weeks and they get, X valuation, I don't think is real. Like Indenaro, for example, I saw it a week after she first started it, and that was almost a year and a half before she entered Y Combinator. So the truth is that
company we're investors of and big believers in, by the way.
Yeah, I mean I love it. Yeah, Jessica's great. So that company wasn't sort of 6 weeks and boom, it got funded. That company was a year and a half. And so I think there's some level setting when you're thinking about this kind of what's happening there at Y Combinator specifically. And then, I think there is a lot of angel money fighting over the same deals, and that's what. And I don't know. I don't have a crystal ball to tell you when that's going to stop.
I've been signaled that we have.
Oh, come on! This panel's going great. We got 10 more minutes. You guys are loving this, right?
Yeah.
That's awesome. Let's steal 10 more minutes. 10 more minutes.
Right. You want to do questions too.
Right. Okay. So I think what you're asking is. So let's get to the. You want to ask a question? I just wanted to respond to his question quickly with some actual numbers. So like the valuations for companies going.
Let's give everyone an opportunity to say a few words.
Okay, so Y Combinator takes 6%. Techstars I think takes about the same. They're usually putting in $15,000 to $25,000. Those companies are being valued at around $250,000. We're doing 50K into companies valued at around $1 million. Seed deals are probably happening $500,000 to $1 million into companies varying between $3 to $7 million. The companies that are coming out of YC are probably going to end up, I would guess, median post money 7. You think? They'll probably raise it between 5 to 10 pre-money. Those are the best of the bunch right now, and they're getting the premium, Goldman Sachs equivalent branding. Not everybody in the rest of the industry. Entrepreneurs in the audience, you're not going to get 7 million pre. Fuck you if you think you're going to get 7 million pre. All right, 3 to 5 million pre, possibly realistic.
I can't believe it. We're already like an hour.
Right, but I think the realistic range in the incubator is $250,000 to $1 million valuations. And then the next round that's sort of realistic, except for YC, is probably 2 to 5 million, right? So the step up is probably 3 to 5 in most cases. In YC, the step up is like a lot. It's like 20 to 50, because they're valuing companies at $250,000, and then they're getting done at between 5 to 10, right? So it's pretty amazing the step up there. Paul's going to make a lot of money. But I think the rest of the industry, like, we need to be careful as angel investors, because we're probably investing in companies between 3 to 7, and the next venture round doesn't necessarily step up quite as much. So that's why I think sometimes we're the sucker round, not you guys.
No. Let's let.
All right, so let me open it up for questions. Yes, please.
So this question, maybe start with Rudy, but then anyone else comment on it. So to use your analogy of the tanker and the rowboat, talk a little bit about, particularly with the growth of early stage investing and angels coming in, why should the tankers want to keep the rowboats afloat? I mean, I don't, talk a little bit about the incentives that the tankers have. For example, if you do a lot of heavy lifting early on, why is it that you expect putting $500,000 in, and this is not just for Web IT, think more broadly, why is your rowboat still going to be afloat when the super tanker comes in, and combined they're putting $30, $40 million into a company?
We're the speedboat. We're not the rowboat. And so okay. So here we are. We are in an innovation renaissance, right? You've seen just an explosion of angel groups across the country. Same thing with incubators, and that's going to continue both in the U.S. and globally, I think. And so there's this huge demand for creative companies, and so as a creative company, you've got to figure out, the level of capital that really accomplishes the key milestones that are going to make an enterprise value difference for you. Now, the thing you have to be careful about is that, there's Y Combinator and the incubators. They're doing great things for some great people, but to be real about it, I don't care whether you've had Y Combinator, whether Dave's put money in your company. I'm going to make my own decision. If Esther Dyson gives you $10,000, to me it's like me giving you a quarter, right? I'll go cash $100 and get everybody in the audience a quarter.
No, I'm-
Does that help you out a lot?
I-
Maybe does, maybe
I don't
doesn't.
know if I asked that question. So how do you stay in the game? If you're early
Oh,
stage.
so we continued it, so
and
what's
they're
different,
putting in
what's
20
different
million
about
VC
funds?
And they're putting in like,
Yeah.
20 or 30 million. How do you stay relevant?
Yeah. So the way we don't get crushed is we continue to invest across the multiple levels of funding.
So, but then what happens, so if the company consumes more cash than you plan, so you're not always selling it at an up valuation where the earlier stage VCs can quote, step back to make room, and they have to keep doing their pro rata because you got a couple of tough rounds in there, because maybe you have a CEO transition or a channel distribution, then it's really scary for the early stage funds. I have this in one of my companies right now, good company, but there's an early stage fund that has 40% of the preferred, and at one point I said to the company, I said to the VC who's on the early stage guy on the board, company's burning $1 million a month. Can you keep up with that? Because he was urging the CEO on go, 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 and I'm like, I don't really want to put more of my cash in at this stage because it's unproven. You're urging him go, go, go. Your pro rata is $400,000 a month on your $30 million fund. You really want to invest that way?
So that's why I think a lot of seed funds should have a bias towards revenue, which we do. And if you want to play the growth game along with the larger VCs, then you better damn well be able to follow on invest, because that is the game that could happen, is that you could underperform,
Right.
and then you have a down round, and the angel investors
Right,
and early
the pay to
investors get
play
washed
kicks
out.
in,
Right.
yes.
But I think the other thing that's happening is monetization's also getting better.
Right.
So we encourage our companies to have a bias towards revenue over growth,
Yeah.
and get to that $5 million revenue number with $1 million in profit, and then they don't
That's-
have to get fucked with.
that's the key.
Right, it's much
investors.
safer. If you're
That's
not
the key.
consuming cash,
And
it's
the
safer.
angel investors are also hopefully not getting screwed in down round.
Okay, we have time for 2 more questions.
Yes.
Yes.
I'd like to know what you guys recommend for a company that has great engagement numbers and small but growing user base. What do you think the next steps for a company like that should be?
Get people to pay. Get
Yeah.
highly engaged users to pay.
Okay.
Get
I mean,
revenue.
yeah, so-
How about vis-a-vis talking to angel and venture investors? What's your
If
word
you
for?
don't get them to pay,
what's
go
your
talk
word
to
for-
big VC, because they're gonna have to finance the time period between when you get them to not
Yeah,
pay. Okay.
turn on a subscription model. It depends what you're working on, but if there's any kind of subscription or a freemium that you get them to pay for, I mean, the guy that did Zeus is a very good personal friend of mine, and he came in very early, and he basically had 1.5 million people on Facebook, highly engaged user base, and he was thinking about taking an angel round, and this is one where I kicked myself because I said, are you crazy? Turn on a subscription model. So he did both. He turned on a subscription model, and he took a VC round. And a couple months later, I went and talked to him, and his head was in his hands, like, oh my God, what have I done? I could be banking $200,000 a month if I never would have taken this venture money, because I've spent none of it. And so, so that's an example. However, they're doing something like 90 million in revenue this year after taking a few more rounds, so it worked out in the end. But I think, if I had a highly engaged community, I would try to find a way to monetize that potentially, unless you think you can really expand that user base.
One more question.
Blood-sucking venture capitalists
That's me.
are still smarter than MBA graduates.
Well,
How universities
that's
can
unnecessarily
make
adversarial.
MBA smarter, in particular, what should be fixed in the curriculum?
Oh, that's a great question. Yeah. So I taught a class with BJ Fogg 3 years ago at Stanford. That was the first time I was ever doing teaching. It was a Facebook application development class. Admittedly, in a time when Facebook had loose distribution policies, but 5 of the 25 teams in our class had million user apps. A bunch of them dropped out and either sold their companies for maybe 6 figures, not huge, but for college students, that's pretty amazing. I think it was probably $1 million in Facebook advertising revenue that was earned by the class that year. One of them got funded and is still operational, building a great business. But the thing that happened after that was the iPhone class came, and now there's a Launchpad class, and what you're starting to see is no longer entrepreneurs going to business schools to read and write case studies. They're going to build companies, which is what they fucking should be doing. It's the lab, not the theory. I mean, go ahead and read the case study if you want, but don't study somebody else's case study. Do your own case study. and build those businesses. So what you're starting to see now, I think, in a lot of these schools is people building the businesses rather than studying other people's businesses and learning on their own metrics. And actually, I would say incubators are not in competition with other seed funds or big VCs. Incubators are in competition with business schools.
Hey Dave, wouldn't it be fun though if business schools, instead of writing your essays, you actually had to write a business idea that you were going to work on for the 2 years you were in there?
Why not just build the idea that you're talking about? Because rather than writing a business plan, which is over-engineering for the outcome that you haven't predicted yet, go build something and get it in front of a customer
And
and
some
then
of us are
develop.
doing that. We're building
Right.
our own companies, so.
Right. So I mean, I think that business schools
Best
are going to
use of
start
business
looking
school.
more like incubators. Incubators are going to start looking more
The
like
most,
business.
the most
schools.
successful people in my MBA class didn't actually graduate. They started,
Right.
they started doing
Right, they all dropped out.
businesses
Shit
and they
started
dropped
working.
out because they're like, wow, I just got $5 million and I have 2 million users. What am I thinking? And yeah,
Exactly.
yeah, it's totally true.
Great. I don't think we have any more time for questions. I just wanted to take an opportunity to thank our panel. It's been a really wonderful discussion, and I hope you all enjoyed it.